In our last session, we learned about the double entry principles and how to apply the double principles, and we equally learned about the accounting equation, where we agree that at the level of the accounting equation it states that assets should always be equivalent to capital plus liabilities. We understood that the assets are the present assets of an organization which the entity has as a result of a past event, and from which the entity is expecting to achieve future economic benefits from the usage of those assets. We accepted that there were two types of assets, current assets and non-current assets. As a matter of fact, you can see an illustration of on our screen. We can see how a balance sheet has been balanced, where we have assets, liabilities, as well as shareholders' equity. We understand that the balance sheet can be prepared either on a vertical format or on a horizontal format. This balance sheet that we see here has been presented in a horizontal format, where we see assets being mentioned on the left side and liabilities and equity being mentioned on the left side. Now we see an example of assets here. Current assets, we have cash. Non-current assets, we have things like property, plant and equipment, and we accepted that current assets with those assets which we expected to be realized in cash within a period of 1 year, and long-term assets are those assets which are acquired with the intention of being used in generating future economic benefits, which obviously should be more than a period of 1 year. Basically, in order to make sure that our balance sheet should agree, we must respect the double entry principles which we learned in our last session. At the level of this session, we're going to look more detail into the double entry principle, how to make sure that at the end of the day the balance sheet should balance. As a matter of fact, you can see that here the total value of assets here is $1,100, which is equivalent to the total of liabilities and equity. So we're going to see how we record more financial transactions in accounting, and how we can fully have a good mastery of the double entry principles as well as the accounting equation prior to us moving forward in preparing a full example on how we can present a full balance sheet or statement of financial position. Let us look at an illustration here, where we have some exercises which were actually undertaken by Digalo Consulting. From there, we're able to understand how we can actually book the various entries in our books. Okay, we have, this is our illustration here. A company engaged in the following transactions. Now we want to see how these transactions should be recorded properly in our accounting records, so as to ensure that at the end of the day the accounting equation is respected, so that our balance sheet or our statement of financial position can agree. The very first stuff we have here is the issued shares for $100 in cash. Now we are saying that if the owner of the company has issued shares for cash, it means that cash will be received $100, as well as another account will be affected. I explained in our last session that to respect the double entry principles is that whenever a transaction occurs, we first of all need to make sure that we identify the two main accounts which are actually involved. Now we understand that if we have issued shares, it means that the equity capital is being affected, or the share capital, as well as cash, which means that we're receiving cash. So the two ledger accounts in the first situation here will be what? You open a T account or a ledger account for cash, and then you equally open a ledger account for share capital or equity. Now cash will be increasing according to the double entry principles. We agree that whenever the value of an asset is increasing, we should debit, and when they are reducing, we should credit. So since cash is increasing, we'll open our cash ledger account, and then we'll debit ledger account, and then we'll open our share capital account or equity capital account, and then we'll credit $100. Now the second transaction here, we had took out a 4-year bank loan. Now I already explained that liabilities are the obligations that the company has because of the fact that they had past transactions, and then they are expected to settle maybe a future outflow of economic benefits. So since we took a 4-year loan, and we know that it's exceeding a period of 1 year, it means that this is a long-term loan. So the two ledger accounts involved here is that since we are receiving cash, whenever we are receiving cash, the transaction must always be recorded in the cash account. Since we are taking a loan, it means that we're going to be receiving cash of $50, and then at the same time we'll be owing the bank this amount. So we're going to debit our cash account with $50.